All right. Good afternoon, everybody. Thank you for being here. We're so glad to have you as members of our LP Advisors Committee and have some visitors as well with us to present the performance of the Rent-A-Sense portfolio thus far. With me is Skyline's Dream Team, Diego, Jack, Shreyas, Connor, Cesar, and myself, David. And we'll walk you today through, as I said, the current portfolio, some market insights, and forward outlook. All right, let's all take a deep breath. It's been a rough couple of years, we all know that, right? But we're confident the market's hit bottom and we're proactively preparing for a new stage in the cycle. Ever since you joined us back in 2021, we've been operating in an increasingly complex environment. High interest rates, supply-demand imbalances, and rising insurance costs have tested this strategy and it's proven resilient. Now it's time to address some liquidity needs and prepare ourselves for growth. We are as bullish as ever on our early bets in the Sunbelt markets where we participate in. We've all seen the trends. We're going to mention them several times during this presentation: migration, affordability, demographics, and we're confident that our position and this portfolio's position is set for growth within this region and beyond. Our immediate focus is clear. First, execute targeted sales while avoiding discounted disposals. Second, reposition our leverage portfolio, our leverage profile, and transition into growth mode for the next stage in the cycle. With that, I'll leave you with Diego for economic outlook, and thank you again so much for being here with us.
Thank you, David. At Skyline Partners, we know your focus isn't just on the numbers, but how these numbers translate into stability, growth, and value to your investments. Our responsibility to the limited partners is about navigating uncertainty and ensuring that our actions and decisions are aligned to the commitment we have with your trust and capital. The US real estate market is at a pivotal moment. We are very confident that the market has already bottomed out and we are now in the initial phases of recovery. These are the 4 pillars that drive our forward-looking strategy: migration, employment, housing affordability, and economic outlook. Demographic shifts have turned the Sunbelt region into an economical powerhouse. And let's be honest, this is no longer a trend. It's a structural shift. The employment market is very strong, with Texas alone adding 450,000 jobs in 2023. Renting has become a necessity rather than a choice, with only 36% of US households being able to afford a home. The Sunbelt region continues to outpace the national average in terms of GDP growth, and we're using this in our regional focus strategy. Our duty is to align these macro trends into a strategy that protects and grows your capital. And here's how we're using these trends in our different assets. Home ownership is getting more expensive, and families are turning into rentals. BTR is a very attractive asset to own, as single-family homes and apartments prices are getting closer. The student housing sector is experiencing a post-COVID resurgence, even with the recent FAFSA issues. With fall 2024 occupancy rates at 85% and a strong rent growth in SEC and ACC locations, we're glad we're strong in this asset type in our portfolio. Affordability and demographic shifts are driving demand for manufactured homes. With national average at 95% in occupancy rates and a strong rent growth, we are confident that this asset type aligns with our income-focused strategy. Population growth and migration are drivers for the demand in self-storage, Although this is a high reliable asset, we know that construction and rent are in a cooling phase. And lastly, well, multifamily. We all know that in recent years there has been an oversupply in this asset, but what we also know is that the development pipeline is decreasing. Multifamily asset in key regions is important to our strategy. And now, I'll give you the stage to Jack to talk about our current portfolio's overview.
Thanks, Diego. Today, I'll provide an overview of the current residential portfolio, focusing on its health and upcoming needs. When looking at the current state of the portfolio, it's important to talk about how we've reached this point. Up to this point, we have proactively invested to be defensive against a market environment that's seen high interest rates and high volatility. Now, going to the future, our portfolio demonstrates significant growth opportunity, but it also requires strategic attention. The portfolio currently has $75 million in cash reserves, and we're anticipating $170 million in upcoming capital expenditures in order to stabilize occupancy across asset types. Over the past 12 months, we have fulfilled $100 million in redemptions, and we have an additional $50 million redemption request in the queue. Going forward, our goal remains clear: achieving 9 to 11% net returns while maintaining a 50% loan-to-value ratio. Now, I know that there's a lot of information on this slide, but let's just pay attention to the most important aspects of each of these asset types, starting with apartments. In the Sunbelt, we have apartment investments across Austin, Dallas, and Charlotte. These investments have seen high rent concessions and negative year-over-year rent growth. However, we remain confident in this asset class because recent absorption rates have outpaced historic rates. We also have apartment investments in gateway cities like New York, Boston, San Francisco, and LA. In New York, post-pandemic recovery continues to drive steady rent growth. However, in California, our properties are only 55% occupied and still require some attention. We've seen some interesting developments in the California market, such as the rejection of statewide rent control, and we believe that demand in California will remain strong due to constrained supply. Moving on to student housing. Enrollment growth in the major universities where we're invested continues to drive our investment strategy in those markets. Build to rent. We have build to rent developments across Austin, Dallas, and Atlanta. These developments require the highest CapEx to stabilize occupancy of any asset in our portfolio at $75 million. We believe that demand in build to rent will continue to stabilize as excess supply is absorbed. And finally, manufactured housing and self-storage. Both of these assets are fully stabilized within our portfolio, and we have high equity percentages in both. Going forward, we have a clear path to grow these investments in order to meet our performance goals. Now I'll pass the stage to Shreyas to talk about risk.
Thanks, Jack. And thank you all for being here today as we navigate the evolving dynamics of the real estate market. Let's take a look at the risks and opportunities that make up the market, starting with the risks. Oversupply in the Sunbelt has led to decreased rents and increased concessions, and this is directly affecting potential ROI timelines. Next, high borrowing costs are making investments more difficult to finance. And this is affecting both, again, investors and developers alike. According to Deloitte's 2025 Commercial Real Estate Survey, elevated borrowing costs top the list of concerns for North American stakeholders. After that, insurance. So in areas prone to natural disaster, insurance rates have skyrocketed. We've seen rates increase by a minimum of 26% for manufactured housing in Florida. After that, we have regulatory risks. With the recent resurgence in rent control debates, this is posing a challenge, especially for our property owners in the Northeast markets. And lastly, inflation. Although building material costs have slightly stabilized, past inflation as well as ongoing trade uncertainties are leading to higher development risk. So although despite these challenges, we are optimistic. And let's take a look at the opportunities. Build to rent. We are early adopters in build to rent. And on average, We are early adopters in build-to-rent, and we understand that this is a promising avenue in real estate. Currently, less than 2% of build-to-rent is single-family rentals. And additionally, build-to-rent is growing 1.2% faster in rents than traditional multifamily housing. And vacancy rates are starting to stabilize, so we believe that there is a long-term plays on this horizon. Next, REITs. Real estate investment funds offer a great way to keep your capital semi-liquid while maintaining exposure to high-demand areas like build-to-rent. Invitation Homes, a leader in the single-family rental space, has an annual dividend yield of 3.3%, which is very competitive, and additionally, REITs are trading at about a 20% discount to NAV. And lastly, manufactured housing. Manufactured housing can be a hidden gem in the right market. With high demand and limited supply, we're seeing occupancy rates near 100%. Additionally, manufactured housing has a stable growth of 4 to 6%, and this is a compelling reason on why this is a resilient and affordable asset class. Thank you, and let me give it to Connor to talk about our go-forward strategy.
Great. Thank you, Shreyas. Okay, are you ready? Our strategy can be broken down into 3 phases. First is sell for liquidity. We plan on disposing of our low leverage, stabilized Florida manufactured housing and self-storage assets to net $240 million in cash. The alternative would be to sell unstabilized portions of our portfolio at a discount, but we're not in the business of selling low and buying high. Furthermore, while we like manufactured housing, we don't like the Florida exposure at this time due to the insurance risk. Second, we'll use that cash in pair with our current cash reserves and future cash flow to fund $170 million of CapEx needs across the portfolio, pay down $80 million of Sunbelt multifamily debt, and fund the $50 million redemption request. This will allow us to stabilize our portfolio at strong returns on costs while also reducing portfolio leverage to our target. And third, we will adjust our allocations. As the portfolio stabilizes, our allocation to multifamily will be higher than desired, and we also have a very healthy pipeline of manufactured housing opportunities. So we plan on selling our Austin multifamily and reallocating those dollars to Sunbelt manufactured housing. Now, this slide actually shows the change in balance of each of these line items each year, and if you'd like to see a more traditional sources and uses, please let us know in the Q&A. We'd be happy to show you. But the big takeaway that we want you to have from this slide is that any CapEx that can't be funded from cash flow is covered by the sale of property, and we've also accounted for all the other outflows to the fund, such as redemptions, fund management fees, and our security sleeve, which we're about to talk to you and we're very excited about. Our plan allows us to maintain a baseline liquidity, as shown in green on this slide, of around 5% in the form of cash and a security sleeve. We plan on investing $20 million into attractive build-to-rent REIT opportunities such as Invitation Homes, which, as Shreyas just mentioned, is currently trading at a 20% discount to net asset values. This allows us to get direct access into this asset class without increasing our CapEx needs. It's also important to note here that we have not modeled any further redemptions or commitments to the fund. We know that right now fundraising is hard, and we believe that our plan should not be dependent on future cash inflows. But also, we're prepared. Should another investor request a $50 million redemption, we are prepared and ready to meet it. Given the current economic uncertainty, we want to be conservative with our use of leverage. The portfolio is currently dangerously close to hitting its 60% target, or 60% cap, sorry. And so by selling low leverage assets and paying down debt to fund stabilization efforts, we're able to raise GAV and lower our leverage ratios to land on the conservative side of our 50% target. It's also important to note here that by paying down debt and stabilizing, we're able to raise our debt yields from 8% up to 11%, which is above the 10% mark that most lenders are underwriting to today. As discussed earlier, our fund came from a combination of defensive and cyclical origins. But as we felt that the markets bottomed out, we want to focus our eyes on growth-oriented opportunities, such as our multifamily and also manufactured housing. And while we lose exposure to manufactured housing in year 1, we quickly regain it at the end of year 2 and continuing through year 3. This plan results in strong, stable growth over 5 years as we pay down debt, stabilize, and overall manage liquidity needs of the portfolios, so investors can expect strong results. The base case would be to do nothing, not fund capex, not stabilize, simply hold properties as they are and sell at debt maturity. Our proactive approach allows us to deliver the strong core plus returns that our investors expected when they trusted us 3 years ago. Open-ended funds need to be ready to face the best of times and the worst of times. Many of you rightly had questions for us on how we would properly position the portfolio to take advantage of growth opportunities while respecting the regulatory and insurance risks. This plan is how we at Skyline Partners are going to exceed your expectations. I'm now going to pass it over to Caesar.
Thank you, Connor. As you hear from my team, today we're very excited to present to you a 5-year outlook of our portfolio, five-year strategy that not only helps us navigate the complexities of today's real estate market, but it thrives in them, actually. So let's recap it. In year 1 to 2, we're going to sell stabilized assets in manufactured housing and self-storage. This will fund our redemptions and also our CapEx strategy in order to stabilize key assets, increasing rent growth and occupancy across our entire portfolio. Then in year 3 to 5, our goal is to optimize and to expand our portfolio, and we will do so by reinvesting in high growth opportunities and also reducing our exposure to multifamily to nearly 50%. Now, you can see that our roadmap aligns with our fund objectives to deliver our target returns of 9 to 11% while maintaining a sustainable leverage and at the same time, strategically bringing flexibility to our portfolio in order to capitalize on the repricing opportunities in today's real estate environment. Now, our team firmly believes in the residential real estate sector. Our conviction in the residential real estate is reinforced by clear data, like migration trends, demographic shifts, and affordability constraints. We understand that in today's real estate market that is defined by uncertainty, we can bring you clarity. And every decision that we take in our portfolio, with every decision, our fund reinforces the trust in our investors while bringing sustainable and superior returns. At Skyline Partners, one takeaway that we want from this presentation is to tell you that we don't only meet the expectation, we exceed them. And with that, we'd like to thank you for your time today, and we're ready to take any questions.